All right, all right. Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns while keeping you up to date with everything that you need to know. What helps investors beat the market is information and knowledge of how to use it. We'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications because every time we drop a new episode, money is made. Okay. Um, so let's um let's dive into something here today, right? Today we're talking about finding stocks that beat the market. All right. And that may be a very one second here. That may be a very, broad statement for now, but we're gonna narrow this thing down um when it's all said and done. Had to plug up my laptop there. So now this thing down when it's all said and done to more of a you know I don't want to say a science, but to more of a more somewhat of a categorical way of looking at stocks. It's specific. We're looking for companies that actually outperform the market, know how to pace things. And today's presentation is actually 100% based on the guided alpha model and the playbook for stock investing. So this isn't pulled from places around the web. This is literally pulled from our own literature. All right. And some of you guys, if you've read the book, you recognize these words here. We are replacing emotional guesswork with clinical mathematical execution. That's what we're doing. All right. You may also remember these words. All right. Amateurs practice until they get it right. Professionals practice until they cannot get it wrong. The things that I am going to be teaching you tonight, I need you to not just, pull up a few stocks, do a little grading here and there, and say, you know what, I think I got it. Right? I need you to work until this becomes second nature. Right? Because this is the type of information that can be the difference between you compounding wealth and you treading water. I believe you prefer the latter. So, guesswork versus evidence. What's the key here? Right? The retail investor consistently loses capital by attempting to predict future price movements based on public sentiment, news headlines, emotional reactions, those types of things, right? And this approach is statistically flawed and it exposes capital to extreme risk, right? We do things like we see a stock that's up, 100% in the past 3 days, and we think, wow, that stock is up a lot. I want that stock, right? Well, what the guided alpha model will teach you is that we should rely on a framework. In this particular case, the dual validation framework. We will audit the actual financial position of a business today, right? And you know, this lets us know some of the predictive data that insulates your portfolio from manipulation, and it identifies some absolute value for you. So the person that's operating on the professional standard, they see that stock that's up 100%. And sure, they may decide to research it, dig into it, find out more about it. But because they operate on a professional standard, the only thing they can do is put a price tag on it and seek out a margin of safety. We're not just independent investors. We're running an operation here. All right. And as somebody that's running an operation, you have to do it in the most efficient way possible. Just yesterday, we spoke about not buying stocks at those highs. And well, today, here we are. The market is now down just about 7% from its peak. You almost have a 10% correction from the high, by the way. It's very close. So, what's the blueprint of the ideal target? Right, that's the question. Right, what stocks like do we look at and do we see as the blueprint behind all of this? Right, which stocks are the ones that we can look at and say, okay, you know, I want all of the stocks that look like that. All right. There is a blueprint. A certain there are a certain set of stocks or characteristics for these companies that just statistically they're known to deliver positive returns and they're known to deliver returns in excess of the average portfolio. We have three pillars in the guided alpha model. All right, quality and solvency. All right, this is the foundation. This is where you verify the business operates with deep competitive advantage, strong interest coverage, and actual cash-backed earnings. There's the growth trajectory. We're confirming the company is actively expanding its top-line revenue and bottom-line earnings at a rate that's superior to its direct competitors. And then there's the valuation hurdles, where we ensure that you don't overpay for perfection. Evaluating price to free cash flows, right? Price to earnings growth, right? To mathematically embed a margin of safety into your investment. All right. Now, next, we have the Piotrowski F score. All right. This is one of the key parts of that entire system that we look at. This is our lie detector here. This is our lie detector. So while the F score is most famous for identifying winners, its primary function in our model is to, eliminate weak companies that are masquerading as bargains. Right? A score of a 6 or higher is mandatory. And this confirms that core fundamentals are actually improving year over year without, putting you at any, additional risk, right? And so you may risk buying, as it says in the book, a melting ice cube, right? That's headed for permanent capital loss. Right? Slowly but surely, your money just melts away. So we have the stress test. The F score ruthlessly exposes businesses whose stock prices are propped up by hype. Right? So if you see a company that's trading, let's say 30% above the average analyst target, but it has an F score of a 4, I would argue that we we should probably walk away from that company before we do something we're going to regret later on down the line. Right? Now, we could also argue that maybe the rest of the world knows something that we don't, and that's always a possibility. Right? But we're not concerned about whether or not the world knows something we don't, because what we do know provides us with everything we need to be a successful investor. And so one of the most important things is to not get caught up in trying to get a piece of every pie. One of the most important things is not to get caught up in trying to, you know, peek over on the, you know, on the desk next to you to see what that other investor is doing. You know, that's one of the key things. Keep your eyes on your own paper, right? Do the work yourself. You'll appreciate it more later on down the line, because sometimes the ones you think who just made the best decision just made the worst ones, right? And sometimes those really terrible decisions can seem like really great ones at the time, right? Um, then we have our other core metrics here: the return on invested capital. This is, the secret sauce, so to speak, of our model. And I know it's like that's not that much of a secret sauce, and I guess we have other elements that play a role, but you know this later on you'll realize allows us to anchor ourselves to quality. Right? We can anchor ourselves to quality. Then everything else is really just trying to pull you away from that, right? And so you can say, no, I'm going to remain anchored to quality here, and everything else has to come to me, right? Um, Interest coverage, which in the first edition will be utilized to determine how well a company can handle their debt, will be replaced with debt to free cash flow in the second edition, and we've already started using that. But also a really great, component here. If a company can handle their debts and their return on invested capital is really great, that is an excellent um, combination of things for a company. Then on top of that, if they have earnings quality, which says that 80% of the company's earnings are in cash. In fact, it looks more like this, right? So imagine this. I'm really happy that I put this particular image together, because this is exactly what you look at for earnings, right? So I want you to imagine a company just reported earnings, and this is what it looked like, right? This is what it looked like right here. 80% of it was cash, and the other 20% was accruals and non-cash earnings. Right? So when you guys see me say that, we're looking for earnings quality and we're looking for the cash to back up the earnings, what I'm really saying is, and I think we went into this a little bit last week, if I walk into a store that I invested in and they tell me that they made $1 million today, and I look at this graph right here, which shows me how much earnings they they generated, and it shows that of that $1,800,000 was in cash, right? And then we had $200,000 in non-cash. Don't be mad at that. But I want you to put this in reverse. They tell you they made 800. They told you they made $1 million in earnings, and $800,000 of that was not in cash, and only $200,000 was in cash. Well, I'm going to ask them, why are they booking so many earnings ahead of time? I'm going to be a little upset here. What are we doing exactly? Right? I'm not going to go the bougie route of asking, are we running a charity? I'm not going to do that. I don't go that far because we love charity. But I will question the efficiency of what they claim to be doing with the capital that I put into the business. So, a growing gap between reported earnings and actual cash is the number one leading indicator of financial manipulation. And I guess, even in hypothetical scenarios, I'm trying to be the nice guy and not call them, a thief or a manipulator or whatever the heck is going on. Why, have $1 million written out and only $200,000 in cash? Okay, so I'm gonna keep my nice guy persona here. I'm not gonna, we're not gonna call them thieves. We're just gonna say, hey, you know what? They got to do better, right? They got to do better. Now, on top of that, earnings, those same earnings that we're looking at that we want to see backed by cash, those same earnings need to grow at a certain rate. Okay? I repeat, those same earnings need to grow at a certain rate. And now, when it's all said and done, we also don't want to pay too much for that growth. So we use the price to earnings growth ratio, and this gives us the growth at a reasonable price. So a standard ratio only looks backward. So the price to earnings growth rate fixed by measuring price against the expected growth rate. Now we prevent overpaying for growth by protecting our portfolio from the perfection penalty, meaning essentially it can get crazy. People can start projecting some really crazy growth rates for companies. And so, do I really want to trade? Do I really want to buy a company at a price that suggests that they're going to grow twice as much as they're actually going to grow? Right? Um, that's the absolute borderline of too expensive for me. Right? Imagine them saying, hey, over the next 3 years, this company is going to grow 50% per year. We just need you to give us 150 times earnings, right? That's essentially what's going on. And, you guys might be keen here to remembering that I think it was last night, with our example from last night, uh, NVIDIA was the most expensive stock in our screener, right? They were the most expensive stock in our screener. But what happens today, right? They're one of the most sold off stocks of the day. That's what ends up happening. That's what ends up happening. We end up buying into stocks at their absolute peaks because we couldn't bring ourselves to check something as simple as how much are we paying for growth. Now, our system tracks how much you're paying for growth in two ways. We'll talk more about that in a few moments. Then we have this reality check here, right? Where we have our price to free cash flow, and this is the metric that we can look at how much are we actually paying for the cash. It's the very same cash I showed you guys earlier. 80% of that is free cash flow. Great. That's excellent. But now how much do I have to pay for that free cash flow? That's the real question. How much do I have to pay for that free cash flow? I don't want to pay too much for that. It's the same scenario as the price to earnings growth. I pay too much for cash flows, and the cash they have may not be enough to support my vision for the company, right? Like maybe they can't even make the investments that I think need to be made here, right? So I need to pay in accordance to the cash flows that I'm likely to see out of the company, right? A lower price to free cash flow indicates a shorter amount of time required to pay back all the debt and all the equity holders. Right? This proves the company is entirely self-sufficient. Now, then we have the combination of high return on invested capital and low price to free cash flow, which is the absolute holy grail. This is what we were doing the other night. Right? High quality companies usually command high prices. We know that. But when you locate a business that dominates return on invested capital, but is priced below the industry average for its cash flow, you have discovered, the exact profile that avoids value traps and compounds wealth. Right? And today, one of the things we're going to introduce is how to calculate a baseline return or expected return. Right? So every penny you invest in a stock is money that you could have invested into a risk-free asset like the U.S. Treasury. So imagine the company, and so this is why this is important to find the right stocks, right? Because when I invest in that stock, I could have invested in the U.S. Treasury. They're giving me 3.5%, right? So I'm going to need a return that's at least higher than that. That's going to be the key, right? We can't allow the market to you can't allow the market to price things for us. We have to price things for ourselves, right? To establish the discount rate by multiplying the historical return of the S&P 500 by the company's beta, right? And you can also add essentially add a prime rate to that if you wanted to as well. If you want to be more strict about how if you want to be more strict about how you discount stocks, that's a way to go right there as well. Right. But we have to avoid value traps along the way, because sometimes you're going to use that discount model that we're going to learn tonight, and you're going to find stocks that say, "Oh my goodness, I think they're worth $100. They're trading at 20. This has to be a bargain." No, not at all. Doesn't have to be a bargain. It could be in the middle of a debt spiral. All right. Too much debt, not enough cash, and costs keep going up. It could be in the middle of a growth illusion. All right. The growth expectations are still there, but the company seems to be making all the moves that suggest they've given up on growth. Right? It could be a company who's falling out of favor. Right? The fall off. Right? All of a sudden we're forgetting, that this company exists from time to time. What happened to them? There's a dividend trap. The yield that looks really good, but in all reality, It cannot be sustained, and they're not going to pay that to you forever. All right. So these are little things that you have to identify as you embark on, investing in more and more stocks. Now, then there's what I call the institutional imperative. So major institutions do not buy stocks because they like a product. They buy because they're mathematically mandated to seek out performance. Their accumulation creates a permanent floor beneath high quality assets. Right? So as you're finding these quality companies, the ones that have the return on invested capital, they have the free cash flow, they can afford to pay their dividend, their debt is manageable. Everything starts to line up about these companies. You're going to start to attract institutional capital. And that's going to create a floor rather than creating a ceiling. Right? And your stock can be supported by that institutional cash flow coming in. And so, but in the end, we boil it down to what we call the performance outlook. This is going to be the most important part of the grading system. We don't just skip right to this because I said it's the most important part. Remember what I said at the beginning, right? That amateurs practice until they get it right. Professionals practice until they cannot get it wrong. But I can assure you, what you do in practice, you're going to do in the game. So the one thing you don't want to do is practice skipping steps. Don't do that. All right? Do not practice skipping steps. What we want to do here, right, is we want to right? We don't want to skip steps, right? What we want to do here is we want to make sure that our process is point A to point Z, right? Without skipping a step. The performance outlook is going to be the most important part of what we do, but it's not going to be so important that we can skip other steps. So I beg of you, do not skip through anything we talk about throughout the program that we're going to be having here in June. Everything has some level of importance when it comes down to the process for analyzing stock. All right. So in the performance outlook, we take the return on invested capital, we add a weight to it. So it goes from having a 1 point in our system to having 4. The F score goes from having 1 point to having 3. All right. Then we have our relative strength. All right. The alpha. We give that 2 points. So these 3 things alone, if we have these 3 things, we have a 12-point performance outlook. And these 3 things represent 75% of the outlook for a stock. Let me repeat that again. These 3 things represent 75% of the outlook for a stock. Right? The return on invested capital and the F score ensure that the company is quality, right? And its fundamentals are improving. The relative strength ensures that the company is currently outperforming the market. And then we have our valuations. These represent 1 point each. Price to free cash flow, price to book, price to earnings. All right? And these particular metrics right here, they all enhance the structural weight, right? They all enhance these points right here. Because if we can gain these 7 points right here, then these 3 points right here are, you know, are going to give us an extra boost because now we're dealing with quality at a discount. Okay. Now, what we really want to do is we want to piggyback on these giants. That's what we really want to do, right? We want to piggyback on these giants. We want to essentially, we want to dig into their mandate, right? They have no choice but to buy what's quality. Give me 1 second, guys. All right, sorry about that, guys. So like I said, so we want to piggyback on the giants, right? So these guys are mandated to own what outperforms, right? And then you have the certain funds that are mandated to own what's quality. And this thing just can continue to cycle, right? It just can continue to cycle and cycle and cycle and cycle. All right. And so this is why for those that do follow our index, for those that do follow what we do, this is why so many of our stocks outperform. Not every one of them explodes, but the great majority of them outperform the market. And the reason why is because we're buying stocks that these guys have no choice but to buy. They have no choice, right? And so this limits your risk. It lowers your drawdowns, right? It makes it so that way, um, in a market panic, there's not a lot that that people there's people that want to sell, but the fund managers will maintain their positions over the long run. All right. 1 second here. All right. So, um, what we do is we essentially we say, you know what, we're gonna establish a way of understanding what we're looking at, right? So we just talked about this one yesterday, actually, right? Where some companies are going to have higher price to book ratios, but that means then that the market's expecting more out of them. So what we don't want to see, right, is a high price to book, and a low sales growth. That's what we don't want to see. All right. We don't want to see high levels of debt and low return on invested capital. These are the types of things that you're going to learn to identify over time. I'm not one of those people that's going to gas you up here. You're not going to learn all of this stuff overnight. All right. A lot of what I'm saying right now is going to, it's going to stick with you in a certain way, but it's not going to really, play back in your mind until certain moments hit. And then it'll start to come back to you. But pick up on the most important things. Pick up on the grading system. We're going to go over a few companies in a moment, and we're going to talk about them, right? But you have asset-light companies, capital-intensive companies, and defensive names, right? These are the different types of operators here, right? So you want to look at it from this perspective. So asset-light companies, these are like in your tech sector type of firms, and they don't require a lot of assets to make money. Your capital-intensive companies, these are the ones that will require a lot of assets to make money. These are the guys that are gonna, they're gonna have a lot of times they're gonna have a lot of debt on their balance sheet, right? They're gonna have a lot of debt on their balance sheet sometimes, and that's gonna be um, something that you want to make sure that you're paying attention to. Uh, is this a normal, a typical capital intensive company, or am I looking at one that has an above average return on invested capital, like we've never seen before, right? What does that look like? Okay, now this is it for the presentation for now. I want to get into the questions and whatnot, and really talk about things, and then we'll get into analyzing some companies. So we're gonna actually do a few questions first, right? And then we'll get into analyzing some companies. I'm gonna do 2 or 3 companies here tonight, um, but we're gonna go through the process. All right, so you'll notice that every night we're going to build upon the process. So I'm not just going to go and dig up 3 random companies. One of them we're going to look at because we talked about it earlier, right? But the other 2 companies we're going to pick via the process that we've already started, right? So we're going to filter out the market. We're going to filter out the market. We're gonna actually screen for certain qualities. This kind of locks in some of the things, right out the gate. And then we're going to sort them out by certain quality metrics and see what we can pick up on. All right. So, what was that? Maybe about a 30-minute presentation there. So I know a lot was said, but what questions do you guys have for me here to start off with before we get into researching firms? What's on your mind? So the first one speaking of as scroll. Mm. Mm. So the key thing with earnings quality is that we have a type of accounting in the market. It's called accrual accounting. And what that means is I can report earnings that I haven't actually seen in cash yet. Okay. And so earnings quality really is all about figuring out which companies are collecting the majority of their accounted earnings in cash this quarter, right? So it's not just a bunch of promises, right?
That on stock analysis.
We're gonna be doing the company in a few, so we're gonna yeah, we'll go through that in a few moments there. Any other questions we have, guys?
I got one more if
Yeah,
no
talk,
one else has.
yeah, talk to me.
When you talked about like the industrials having more debt, like how do we determine what is a reasonable amount when we're looking at those companies
Right.
for that industry?
So a lot of times, right? Um, a lot of times you have newer, younger companies, and so they haven't had a lot of time to build up a lot of debt yet. And then you have the companies that have been around a while and they've been in operations for 50 years. And, you know, it's key to remember that a lot of these companies are never going to pay off all their debt, right? When they finally go down, Anisha, they're going to go down and liquidate, and all of their assets are going to go to paying off their debts, right? So when it comes down to determining what's a reasonable amount of debt, I usually look at the quality of the company, right? I usually look at the quality of the company and let that determine how I feel about the debt if it goes beyond what I'm looking for. So I usually look for debt that can be paid off in one business cycle of free cash flow. That's what I usually look for. So let's say the company's gonna, let's say the company's making $1 million in free cash flow, right? But I don't want to see more than $5 million in debt, for example, right? But let's say they're above $5 million. Okay, cool. You're above 5 million. Now, what I really want to know is, you know, are you a company that's drowning in debt, or are you a company that these banks essentially don't mind lending money to because you just keep returning that capital right over? So the return on invested capital and the F score, if those are still strong, then I am happy to remain invested in the company or potentially invest in the company as long as everything else is fine, especially the earnings quality.
Okay. How do you make that connection where you said like the price of books high, sales growth low? Like is it other combinations that we should keep in mind? I know you said debt to something else, but I didn't get that second piece.
Yeah, yeah. I mean, you can use other combinations. You can, like you can look at the earnings growth, the free cash flow growth. You can look at, like just growth in general is what's expected when a company has high valuations, right? So you can look at the past growth, the present growth, and the future growth, right? And everything doesn't have to be, like we don't have to be overly analytical of it, right? We're more so looking at it and saying, is their growth sufficient? Not in comparison to the price to book, because you never get that answer. Okay, you understand what I'm saying? That answer is not coming.
Okay.
But more so because I have a high price to book, is this debt reasonable? So not done debt. Is this growth reasonable relative to the industry itself? So I want to see a company that's growing more than the industry if I'm going to have high valuations multiples. Okay, and that's the reality. And preferably, if you have an extreme valuation, you better have some extreme growth expectations. Don't give me one and not the other.
Talking about SpaceX.
Hey, But I'm gonna say this, right? That was one of the reasons I sent that to you guys, because you can see there how easily things can be manipulated by the people inside the company. Which is why, what did I say? I said I do not like to go based on management in that way, because it's very difficult to look at management and tell, oh, these guys are this, they're that, and this or that, right? Because look at all the things that they can point out that's really off about this IPO. I already talked to you guys about the total addressable market, right? That's just ridiculous. It's not happening. That's not a true addressable market. That is literally media fluff and a way to get the retail investor extremely hyped about this thing. But we'll leave that alone, right? Because that's a whole other conversation.
So you don't think like reputable CEOs when they first join the company, like sometimes investors get excited because they've seen that particular CEO like completely turn companies around and stuff like that?
Yeah, definitely. No, definitely, yeah. No, you're right about that. What I'm saying is that tells me nothing about the future of what they'll do. So sometimes I love to read the stories of CEOs, Shay. Other times I really could care less. Like sometimes it's something about that CEO that says, you know what, I kind of want to read about this guy. You know?
So basically, all of you don't qualify for that type of that type of honor, I guess.
Yeah, I barely ended up reading about Jensen Wang, as big as Nvidia is, right?
Did he ever run any company before him?
No, he's been running Nvidia the whole time. Yeah. Well, I mean, he's run other companies, but like if we're talking like this longevity path here. So he's been the CEO of Nvidia this entire time. He was one of the founders. Um, started Den- start started Nvidia in a Denny's booth. Again, other stories we get into another time. Um, any any other any other questions for me before we start digging?
Ready to see what company you're looking at big action.
Okay. So, I'm about to pull up a company right now. Um, when I worked in the music industry, this company, Anisha, hear this one well, Anisha. This company pretty much was like the same way Live Nation runs the concert market. This company pretty much runs the music industry from a perspective of like controlling who gets played on radio and so on and so forth, right? Huge business, big business, right? However, however, when I got deeper into the stock market and I started to analyze this company, um, it became very clear that, oh, look at this. I see OTC here. Were they delisted? It's very possible. Okay, no, they didn't get delisted. Okay. So it became very clear that this company just was not as great as you would think they were. So they're up 175% in the past year. In the past 5 years, down 83.5%. All right. Again, this is where numbers can lie to you sometimes. If you want to look at this, fine. But don't forget to look at this. All right. Now, before I pull up the Oracle X and start digging through companies, I am going to walk you guys through this one pickle at a time. All right. So, stock analysis, statistics tab. Okay. Um, Over here you can see your earnings yield and all that extra stuff there, right? Um, this is where you find your yields. So they don't pay a dividend. So we're depending on this company for nothing but capital appreciation. All right. And we're just gonna look at things on the way down. Okay. Um, their revenue growth is right here. We're gonna have to compare this to other companies in their sector at some point. They don't have any earnings growth forecast. There's only 4 analysts on the stock, and they all have it rated to sell. Okay. None of these are a part of our grading system. Let's get into the grading system now. All right. First part of our grading system, the Petrosky F score, right here. Okay. We're looking for a 6 or better. One of the things I love about coming over to stock analysis is that we get to see things that we wouldn't otherwise see sometimes, right? Like, for example, the Altman Z had a minus 2.32, minus 0.32. Now, this isn't going to matter much in the grand scheme of things because guess what? Our entire analysis is going to prove to you um, that this is exactly the case, right? So the F score, this is a 6, that gives them 1 point. Okay, they get 1 point for that. So this is where the grading begins. Okay, so this is called the investment grade. And the F score is the first point. Okay? Now, the next point is our price to book ratio, which we'll find up here. You'll see the price to book ratio says NA. Now, a lot of times this means that the company, is negative equity. What does negative equity mean? Negative equity means that the company is actually, on paper, they owe more than they own. On paper, they owe more than they own. So that's more liabilities than assets. And well, that means the company's, you know, um, big air quotes underwater right now. Okay. Now, so you can see here, their total net debt is $5.7 billion. All right. The company themselves is worth $607 million. Let's just put that on the table right now. Okay. I repeat, their total debt is $5.7 billion. They're currently worth $607 million. So that should tell you something right there. Okay. It's great to look at bad companies sometimes because it'll help you out in the future when you want to identify great ones. All right.
When you say the debt,
The debt 5.7, actually 5.8 billion. I was billion.
I still haven't. Okay.
Yeah, $5.7 billion, and their actual market cap is only $608 million. It's craziness. Now, here's the deal. Right? You can see here it says their equity book value is a minus $1.92 billion. Okay, so their book value is minus $12.33 per share. The stock is only at $3.80 per share. Anyway, neither here nor there. Our price to book, we cannot calculate it because our equity is negative. So that means on price to book, which is our second measure, they get a 0. Okay, we give them a +1 if they get the score. If they pass the test, they get a 0 if they don't pass the test. Next test here is the return on invested capital. Let's see what they got going on over here. So you can see it says the return on invested capital is 5.88%. Now I can guarantee you, 100% guarantee you, all right, that there's no sector in the market that is averaging less than 5.88%. Just ain't happening. So we already know that this isn't good enough here. All right. But we'll check in on that in a few moments. So that's another 0 there for them. All right. Next is the price to free cash flow. Well, it says that they're free cash flow negative, so we might as well we might as well not even bother to go look for that. Okay, price free cash flow is negative, so another 0. This is not a good start for iHeart. Again, this company is the largest outdoor advertising firm, the largest radio broadcasting firm in the world. And if you think about falling for that narrative, nobody listens to radio anymore and all that stuff. Trust me, they find other ways, to navigate that. And you'd be surprised how many people actually do still listen to radio, right? Still listen to the radio. Exactly, right? You'd be very, very surprised. Now, the next thing we're looking at then on our list is the earnings per share growth. Okay. We're going to go over here to the financial statement. We're going to go trailing 12 months. Well, revenue growth is already in the negative, so that's a no-no. And you can see look at this. Their revenue is just dwindling here. All right. Now, let's keep going. Scroll on down here. Earnings growth right here is a no. All right. That's that earnings growth is currently a negative. All right. So that's a 0 for that and a 0 for sales growth. It's not looking so good for these guys. So far, they scored 1 point. That's the F score, right? 1 point. Now, next thing is our price to earnings growth. We're going to go over to the ratios here. And our price to earnings growth is non-existent. But we do have an average price to earnings growth here of about a 1.28. I'm gonna give them 1 point for that. Okay. Because we at least know their average is just consistent. Right? So consistently you can pay a pretty decent price for this company. I mean, you can see that, right? The next thing we're looking for is our debt to free cash flow. Okay, let's go back to our statistics tab. Now, it makes no sense to even look for the debt to free cash flow. Why? Because the free cash flow is what? It's negative. But our debt to EBITDA is 7.68. So we have 7 years of earnings couldn't pay back all their debt. Does that sound like that's a good one for y'all? I said 7 years of earnings couldn't pay back their debt. Sound good to y'all?
Not today.
All right. So I usually don't like that. Now, so this is one of those cases right here, Anisha, where if everything else was looking pretty fine, I wouldn't judge this so much. You know what I mean? But everything is not looking fine. So therefore, this does matter a lot now. Because now I don't think you can pay your debts. I don't think you can pay them. I think you're going to default on your debt eventually, and you're going to go bankrupt. And you probably already went bankrupt at least once. Okay? The last but not least is the earnings quality. And like I said, doesn't matter because the free cash flow is negative. Okay? So this company scores a 2 out of 9 on the investment grade. Now, the reason why I said the performance outlook is the most important piece, right? Because you don't want to have too much of your you don't want to have too much of your eggs, in one basket, but also you don't want to have uh, the actual outlook of the company diluted by other statistics, right? So we know that the F score gets them 3 points, but they have 3 out of 12 on the performance outlook. So that is most certainly a high risk outlook. Okay. So they scored 2 out of 3, which is a strong sell and a high risk in my book. Let's see it might pan out to be a sell with a negative outlook, but let's see how our system grades them up here. All right. Let's refresh so that way we can, all right. So you just saw me grade it. Now you can see all your elements right here. 1, 2, 3, 4, right? You can see all of your elements right here. So let's see what they give us here. So yeah, probably like I said, probably a sell with a high risk or a negative outlook here. All right. You can tell it's over there like I don't think we can find any of this stuff.
It seems today that the Oracle X is running a little slower.
Mm-hmm.
Maybe it got something to do with the internet or something.
Nah, I think it has to do with that sell off. You,
That too.
you ain't never noticed on days where the market's really red, everything gets lower.
Okay.
Yeah, everybody is out there saying, "Is my stock any good anymore? Is my stock any good anymore?" They just trying to dig, boy. Yeah, your stock's still good. Don't worry, you'll be all right. Oh, they can't even get them. Interesting. Let's try it again. I guess that's what happens. I guess there's so many NAs for them, then that's what it is too.
Get that too. I looked up HPM.
Oh
So I
yeah.
don't know. It's just something seems
Only one stock did it for you?
right. No, a lot of them were just doing it, so then I just stopped.
Okay, okay. Yeah, it's probably the sell off today. But that's one of the main reasons why we learn to do it by hand, right?
Yeah.
Let me ask you a question. Did you do any by hand?
Oh, not today.
She
I was
said,
watching my I was watching my trades today, but
oh yeah.
yeah,
Oh, I saw you post in the chat. You was booming today.
it was a lovely day.
Mm-hmm.
And more so learning too. Just continue, seeing what I see. Trying to just make sure I'm seeing what I see. So that's
Yeah.
always fun.
Definitely, definitely.
Hey, I got a question.
Yes, sir.
Well, first of all, it's on everybody. But the outlook and the grading, right? If it's a sell, is that like would that technically the inverse, like, so in other words, if we don't mind, like, would that be like like a like a long short or something like that?
No.
On a company like that? No,
Yeah,
it's just like, don't mess with it.
yeah, yeah. You don't want to do that.
Okay.
Yeah, that'll get you burnt. Because like a lot of times they can buy. A lot of times people can buy the worst stocks, man. People buy the worst stocks. You got to keep that in mind. Now, just for the record, right? Even if the analysis isn't running at this very moment, because of whatever's going on, with the certain networks and whatnot. Because, like I said, it becomes a really high traffic time period where they're trying to, limit data. So, but everything else um, should still run. Let's see what goes on here. So this still could be a place where you come to learn more about the company, even if, right? So just want y'all to keep that part in mind as well. All right, so as you can see that? So you can still come here to learn more about the company no matter what. So even if right now the the data is being slowed down by stock analysis, that's not going to stop your other points. Okay, so I just want y'all to keep that in mind. So you can still say, okay, what do I need to know about this company? So he says stalled acquisition talks with SiriusXM. Whoa, okay. They experienced a significant negative catalyst after Dealbook reported that early stage talks regarding a potential sale to SiriusXM have been put on pause. Shares fell approximately 17% following the news. SiriusXM buying iHeart? What a turn of fate and fortune. That is crazy. Anyways, so let's get to our screener tool here. So you'll come to FinViz, go to the screener, right? And so one of the things that I want you guys to really note when I say not skipping any part of the process, right? Like sometimes I already know about a company. Fine, I already know about them. So I can just start researching from there. But when you don't know anything yet, you start with the screener. All right, country, U.S., stocks only. All right, go to the fundamentals. Right, I want my earnings profitable. Right, I want my earnings growth this year positive. Earnings growth past 5 years, I want that positive. Sales growth past 5 years, I want that to be positive. And my price to free cash flow, I want that to be below 40. Right? Now, what do I end up with? 617 names. Yeah. So you can notice this 617 has been consistent, guys. Y'all notice that? So what I like to do is I keep the same base filter, and what ends up happening is when there's really more opportunities in the market, this number is going to go up. In fact, it's up by one stock right now. Right? It's one stock less. There's one stock more here. It was 616, now it's 617. So one other stock joined the list. All right. Now, let's go. And by the way, when I say more companies will join the list, it's really because of the price of free cash flow. So when I do this, there's 809 stocks. That's possible if they can just pull back below. Hold on one second. If they can just pull back to below 40 price of free cash flow, then I could have up to 809 opportunities. If that makes sense to you guys. All right. Now, order by, I'm going to put the order by price to free cash flow. And I'm going to leave that in ascending order. So, and I do the same thing repeatedly. So I'm going to split these groups. So we have 31, pages. I'm going to treat it like we have 30. Okay. So I'm going to cut off that 31. Treat it like we have 30. I'm going to split this into, right now I'm going to split it into 6 groups. So page 1 through 6, right? We cannot invest in. Page 30 through 26, right? 30 to 26, we cannot invest in either, right? So here we are. All right, I'm 25 to 30, I meant to say. Yeah, 25 to 30. We can't invest in either. All right. So here we go. We can start here on page 7. This is going to be our value stocks. 7, 8, 9, 10, 11, 12. Those pages there are going to be our value companies. Right. Just inside of those companies, 13, 14, 15, 16, 17, 18, 13 through 18 will be my the beginning of growth at a reasonable price. Right? That's the value side of it. On the growth side of growth at a reasonable price, I'm gonna have pages 14 through 19. Yes, 14 through 19. All right. So really I have pages no, I'm sorry. 25. 20 through 20, 19 through 25, I meant to say, are going to be my growth at a reasonable price, I meant to say.
Is that 19 through 25 or 19 through 24? Because you said 25 through 30.
19, 20, 21, 22, 23, 24, yes. 19 through 24. All right, thank you. All right, are going to be the second half of my growth at a reasonable price. All right. So I'm just going to kind of lean into those companies there. All right. Now, or I can just focus on the 7 through 12. I'm sorry, not 7 through 12. 18. What is that? 13 through 18. You focus on those stocks right there, and those would be really the best ones overall. All right. So let's just go to that. Let's just go to that group to start off with. We're just gonna put ourselves like smack in the middle of growth and value. That's pretty much what I'm doing. Okay. So Let's see here. Let's see. I'm gonna look for stocks in certain sectors this time around. So because the market just dropped, let's actually take a slight glance. Let's take a slight glance at some. Take a look at some healthcare names real quick. All right. Let's go to the overview tab here. All right, let's go to financials. Okay. So I can see right out the gate a few names with some really high return on invested capitals. Y'all see these guys right here? See these ones in the green? See all these ones in the green? These are going to be the ones you want to focus on because they're going to be the ones that have the lowest score as far as the magic score goes. All right, these are going to be the ones that have the lowest grade there. All right, so we're just going to come right to page 2 to see who's on page 2 here. And we have MedP. Wait, didn't we look at these guys recently? I could have swore we just looked at those guys. MedPace Holdings. These are one of the ones that popped up in the screener the other day, right?
On June 3rd on our list.
Yeah.
They were ranked very good at ranking.
I got you. I still have the list.
Yeah.
I got it right here.
Difference between Otis and MANH. Yeah.
This is it right here. Yeah. Actually, they ranked number 1. They were the top company of all of them.
Yeah, that's what I'm gonna say though. That number one. Right.
All right. Yeah. This was the best company we found that night. Okay. Now I don't know if we can get any data on them. We'll see if the Oracle X is going to be pulling up any data tonight or not. All right, let's take a little glance. We'll see, I guess. Um, doesn't look like we're going to have any luck tonight with this one. So I'm going to go and grade them by hand. No, we just need to read about them, right? We never read them.
Yeah, we just needed to look at the ones that passed the test.
Right. So we never got a chance to look at them. So I guess that's perfect for tonight, right? Because we never got the chance to really dig into that. But no, they still got iHeart popping up. We gotta wait till MedP is done. Yeah, you see how long it's taking to do number 1 there? It definitely says that they're slowing down the data. It never took that long to do number 1, right?
Yeah, that makes sense though.
Yeah. On days like this, I notice that all the time. They don't want to give up too much data because of everything that's going on. It's one of those days where everybody wants to know something about a stock.
Too bad they're not researching it before the fact.
Exactly, right? I like that. I like that, Jared. I like that, man. That's a fact. They're researching it like we did. We already got our list.
You don't wait till you shit your pants to go run to the computer.
Yeah, man. But today was definitely a good day. Just holding on to those S triple Qs, protecting your portfolio, right? You should have definitely had some limited downside today. For sure, for sure. Yeah, no. Yeah, they don't want to. All right, let's do the analyst though. Let's get our red flag reports and all that stuff going. Okay, a clinical research organization providing integrated phase 1 through 4 development services primarily to the small and mid-sized biotechnology sector. The company differentiates itself through a centralized physician-led model that manages the entire drug development process internally rather than outsourcing components to various vendors. Okay, that's interesting. So this is what we call vertical integration, guys. So if you excuse me, if you've ever heard the term vertical integration before, this is what that looks like. Ma'am, this is what that looks like here. Vertical integration, right? So basically it says um, a centralized physician-led model that manages the entire drug development process internally rather than outsourcing to various vendors. That's vertical integration. That's like, you know, I'm a car manufacturer, but I also have my own aluminum a smelter, smelting plant, and I also own my own tire company, and so on and so forth. Right? That's vertical integration. Right? I can really do everything my company needs on my own. Right? That's what that um that's what that looks like there. Now, it says there's major opportunities in the resurgence of capital market funding for early stage biotech and increasing complexity of specialized therapeutics areas, while significant threats include a high exposure to volatile R&D budgets of smaller firms and competition from larger, more diversified clinical research organizations. The stock price could increase if cardiology trial markets um, hold on one second. I'm sorry. If the company demonstrates, accelerated backlog conversion and captures a larger share of the rebounding oncology and cardiology trial markets. Conversely, the price could decrease if a restrictive credit environment leads to elevated project cancellations or if client funding dries up, impacting long-term revenue visibility. Ultimately, MedPace serves as a high beta proxy for biotech innovation cycle, right? Where the premium valuation is tethered to the health of the broader life sciences financing environment. That's pretty interesting. I think I like them more than I did, you know, a couple of days ago when we first looked at them. Now I'm going to do the grading by hand again. We like days like this where they're trying to limit the data that we're getting because it gives us an opportunity to really, right? You see how I can grade the entire thing by hand, right? Because again, I didn't practice until I got it right. I practiced until I couldn't get it wrong. All right, here we go. F score 7. That's 1 point. All right, let's keep going. Debt to free cash flow 0.21, really great, excellent stuff. Return on invested capital 475%. Now, while this is a passing grade here, right? They're 3 for 3 right now. Let me just point out that 475% is not sustainable. So they get a point, but a little bit of a red flag there. That could be something that slows down over the long run. Price to book ratio 21.68. Again, this is still useful because I can come over here and say, let me see here. Average price to book. And that's average price to book in that sector. Right? I know. Relax. All right. The average price to book in that sector is a 4.4. All right. And so that's something that this 21.68 just puts us way over that threshold. Okay. So, the most we would have been willing to accept is an 8.8, or let's just call it a 9, right? Because we don't want to be more than twice that we don't want to be more than twice that the book ratio of that particular sector. Okay. That's when you just know you're doing way too much. All right. Now price to free cash flow is at 18.25. Let's slide back over here again. Price free cash flow right here. Healthcare is at 22.2. So we're good. We're good enough in that area there. All right. So far the company scores 1 for F score, 1 for return on invested capital, 1 for debt to free cash flow, a 1 for price to free cash flow, but they don't get the point for price to book. So far they scored a 4 out of 5. Excellent. Okay. Next, I'm looking for earnings quality. Free cash flow per share, $24.90. All right, earnings per share, $15.90. So they make more, and they brought in more cash than they even reported to us as earnings. So that's great. All right, so now they score a 5 out of 6 here. Okay, they score 5 out of 6 here. Earnings growth, projected earnings growth is solid. Let's go over here to our financials, trailing 12 months. All right, revenue growth is in the double digits. This is what we were talking about earlier. We have a high price to book company, and our revenue growth is in the double digits. That's great. That's exactly what we need. All right. So 6 out of 7. Earnings growth itself is double digits. 7 out of 8. And then last but not least, the price to earnings growth. Let's go over to the ratios here. Price to earnings growth is much higher than it usually is. Well, not much higher, but it's higher than it usually is. But it is below 2. That's so we require it to be below 2, and so we'll accept that. Okay. So the company scores, as we saw there, they scored an 8 out of 9. And they have an exceptional outlook, meaning they get 12 out of 12 points on the performance outlook. How do they get the 12? The return on invested capital, if they score that goes 4 points towards the performance outlook, right? If they get the F score, that's 3 points towards the performance. Okay. if they get relative strength, right, then that's going to be another 2 points towards the performance. Then your earnings quality, your debt to free cash flow, and your price to book, right? I'm sorry, so they score 11 out of 12. I meant to say, right? That's what it had to be for them to get that. So the company looks really good in that regard. And so you look at that and say, well, based on what I learned about the company, or what I'm learning about the company, and everything else that comes along with it, all of the fundamentals and those things there. Well, what does that look like for me? So that's where this whole thing comes in. And if you notice, the same stock popped up as one of the top companies in healthcare, right? Yet again, when considering the price to free cash flow and relative return on invested capital. All right. So now, does anybody have any questions now? Before we close out, any questions now that may have come to mind as we analyze these companies? All right. Well, as I said, each process is gonna. Oh, go ahead.
So when you're bringing up the Oracle Exxon company and you see the red flags, what type of red flags would you put less weight on, and what would you put more weight
I put less weight on red flags that that are just not um that I put less weight on red flags that don't prove that I'm not looking at a quality company, right? I'll put it like that.
on? Like more speculative red flags that haven't been proven true yet. I mean, like,
Or it can be, the company has high debt, right? That's a red flag.
okay,
However, they also have a debt to free cash flow. I'm sorry, return on invested capital of 300%, right? Well, for now, that that debt to free cash flow, that high debt, is a little less of a concern to me, right? So that doesn't necessarily prove they're not a quality company. It just proves that they have a decent amount of debt. All right, but guess what? So does the world's richest man, and he still manages to make more money, doesn't he?
and then what are some of the red flags you look for that are like, even if everything else looks good, you might just be like, oh,
Well, that typically would involve the company itself, because you're not going to say everything looks good, but you're going to find red flags that are significant. So it would have to be something about the company itself, like um, the way their way of operating, their business model, those types of things. It would have to be something qualitative, not quantitative, because if everything quantitative is saying the company's great, then only the qualitative factors can prove it's not.
what about less than red flags? I saw a company, everything looked pretty good, except it was saying that they were making the numbers look better than they were by selling one of their largest mines, and then might be moving to a different territory. It could have to do with it was kind of speculative, but could have to do with like policies in that area and stuff like that. I didn't know how bad to look at that as. And like if they made their income look better than earnings because of selling a huge asset, one of their biggest
Yeah, I
assets.
mean that's very very possible that's the case. That can happen. Companies can get some excess cash on their balance sheet and look better than they actually do. In real life. You know.
And how bad would you look at that as? Like you just think, oh, maybe it's just a one time thing. Like, would you look for that to be repeated?
I mean, well, I don't look for problems to repeat themselves. My automatic assumption is that management knows what they're doing, and if I felt like they didn't know what they're doing, then and there's no need for me to invest. All right. So either I want to invest. I mean, because the type of company you're describing here, it's one of those, don't get caught up in analyzing companies and digging into companies that you already see things that you're that concerned about that you have to hang up on it. Right? There are too many great companies out there to get caught up wondering whether or not this company is padding their balance sheet, or you know what I mean, or I wonder if that mine that they sold is really the only reason that. So in that reality, it's kind of one of those things where I'm making up my mind right now. Either I trust the management or I don't. Right, and that's what I mean when I say I don't read too deep into management, because the numbers tell me everything I need to know. The actual, like, what you're saying right now tells me what I need to know. Right?
Like if the numbers look good, it's more likely management knows what they're doing, and you could probably trust the decision they're making. But it's
Right. Right.
yeah,
So do the numbers look good enough that um hanging up on this point right here makes no sense? Or do the numbers look pretty bad? And well, that's exactly why you're looking at this, right? There's no in between, in my opinion. Right? The numbers either look good or they don't.
Did he run it? Did you run it through the Oracle XShared? And what was
yeah. That was where I was reading the red flag.
That's where you got that from. Yeah.
It was pretty good. I had a score of like 8, and then it
had a buy favorable or a buy?
I think it was like it was either a buy favorable or buy exception. Fine. Yeah, but it was like uh, everything else looked pretty good. But then I didn't know, because a lot of companies that look good have a lot of red flags. But I was just trying to figure out which ones, actually to worry about.
You want to scroll all the way down to the bottom of the red flags, and it will right. It'll give you a cumulative breakdown. Sometimes it says no severe red flags.
Oh, okay.
It'll say that, right? Like, I can't tell you whether I believe that's a severe red flag or not, because I didn't look at the company. And that's kind of what I was getting at. But if I was looking at a company that looked really great, right, numbers wise, that's not a severe red flag for me, because again, my assumption is going to be that management knew what they were doing.
Yeah, that makes sense.
Why would I assume anything other than that? If they can build a company that looks this good, right? Then why would I assume that this was now they want to go about a manipulation tactic at this point?
Yeah, like what?
After building a company that looks this good, they want to manipulate things. Right? It just wouldn't make sense to me.
So the Oracle red flag is instigate.
Again, if you read straight through it and get to the bottom, it'll let you know if those red flags are severe or not.
Okay.
It's designed to do that. Right?
Okay. I might have missed this. Like, where's it pulling the red flags from? There's like news articles and just they're looking through 10Ks.
Everything that it gives you up top. So all the earnings, the backlogs, whatever's there, all the information about the company that it already pulled up. It's running through that information now for red flags.
Okay.
All right. So the grade of the company, all that stuff, the valuations, everything.
Okay. Yeah, I was more just trying to get an idea of like what red flags are you should look at more closely. Like, okay, that's might not be good, and then which ones are. But I didn't realize that it had a severity rating at the bottom. That'll help for sure.
Yeah. So again, companies that have too much debt and not enough return, it's a huge red flag. Huge red flag. Right. Companies that have too high of a valuation and not enough growth, huge red flag. Companies that have too high of a valuation and not enough quality, huge red flag.
Mhm.
All right, these are. You writing this down?
I'm when I watch the replay, I'm gonna take notes
Okay, gotcha. All right,
because I'm right now. I'm like,
gotcha. Right, so it's a combination of things that create the big red flags for me. I'll repeat that.
yeah,
The companies that have too much debt, not enough return, that's return on invested capital, huge red flag. The companies that have too much debt and not enough growth, huge red flag. The companies whose high valuations are so high and they have no growth, red flag. The companies whose valuations are, you know, too high and they don't generate a return, red flag. Companies that have F scores below 4, red flag. The F score itself is a combination indicator, right? That's 9 different things. So 5 of those things are saying there's a red flag. All right. Low earnings quality and high debt to free cash flow, red flag. So these are the combinations I look for. All the ones I just mentioned.
that makes sense. Yeah.
All right. When I see those two things together, great. I'm going to read through the red flags report. It's going to say the things that I'm saying right now. If I read through the red flag report, it's going to say those same things. Right? It was built on our system anyway, so it knows what we're looking for red flags. You feel me?
Yeah, no, definitely. Yeah. And it makes sense those relationships are interesting.
Right. They just don't go. They don't go well together.
Like if they're making a lot, they're not making a lot of earnings. They got a lot of debt. How they not paying up? So it's
Right. Exactly.
that's it.
Like that. Right. Or they got a lot of debt, but they're not getting a lot. They're getting a lot of. They got a lot of debt. They claim a lot of earnings, but they don't get a lot of cash. Right. Red flag. That screams manipulation right there, Jared. Right. That's what screams manipulation. Hold on, you're trying to play me right now. Thank goodness I look at cash because we refuse to be played.
It's like a scammer.
Hey, I don't want to use all these words around here,
Same.
We say manipulation around here, you know. Yeah. Does anybody else have any questions? Anyone else have any questions before we close out?
Anyone who thinks that's awesome.
Um, I don't think it's gonna do. I don't think it's gonna do very well because it's not gonna have a lot of history, to go off of. Um, I think it might fall in the lines with many other IPOs, you know. But hey, man, I'll say this: um, the stock still has a lot of potential to go up on its IPO, but I'm not going to give it any. Um, I'm not going to think of it any different than any other IPO. You know, there'll probably be some money to make on the upside initially, but I think like any other IPO, it'll eventually find its way below that initial price at some point. So, and it'll be just because of the same reasons we're talking about right now. It's not going to be as good as as we think it is. we're starting to start to realize that the growth may not be exactly as we thought. The earnings may not be exactly what we thought, and so on and so forth. And then we'll have to start pulling back on some of our investment.
Right, I agree. I think it's going to pop for like 2 weeks and then it's going to fall. That's just my opinion.
Yeah, definitely. Does anybody else have any questions before we close out? Okay. Um, as we dig deeper here, all right, I'm going to eventually do a lot of these uh, components a little more in depth. All right. Tonight was really just about understanding, what these quality companies look like. And you can see the difference between iHeart when we analyze them and MedP, right? MedPace, when we analyze them, you see the difference, and the difference is that, um, one of them has this quality grading that quality grade that shows what could happen with them over the long run. Look, they're up 2% in the after hours. Pretty interesting. I don't know what they look like over the past 5 years. Let's see. 168%, guys. Notice the difference. So this is MedP. They are um a strong buy with an exceptional outlook. This is iHeart. They are a sell with a negative high risk outlook. So what could we see here? Right? We can see that a company um that has a high grade right now, just between these two companies, they're going in the total opposite direction. Now, I'm not going to say that it's 100% due to the difference in their grades, but what I will say is it's not a coincidence that they have that difference in their grade. Okay, um, you can believe what you want to believe. The numbers are right here on your screen. All right, iHeart scored a 2. MedP scored an 8.
So we can see how important that free cash flow, the F score, all of that is.
Right. All right. Look at this stock. All right. I'll show you one more time. And look at this one. All right. Night and day. One is quality, one is not. And in a time where we want to put our money into quality, this stock has been proven right. All right. So, anyways, guys, we'll catch up with y'all later. All right. I will see you guys on Monday, I guess, for those that so how did you guys enjoy the first week of Value Investing 101? Did I Yes. Gotcha. All right, happy to hear that, man. Um, you know what? I probably missed a bunch of questions over here on the chat, didn't I? Okay, no, I didn't. Okay, good. All right. So I'll catch up with you guys on Monday for those that'll be here. Then for some of you guys, I'll see you guys tomorrow in our portfolio mastery program. And for some of you guys, I'll see you on Sunday in Division 1. All right. Everybody be blessed. Stay well. And I'll talk to you soon. Later.
Thanks so much. Thank you.